Hey everybody, hey traders, happy Monday. Happy Monday afternoon. It's 3 p.m. time for the final hour. This is Chris Pulver here. How we doing? This is a session I'm going to start doing every day. So for those of you that would like to follow me, get some more live sessions with me, here's one good way to do it. So let me bring up the chat and say good afternoon to everybody. You may be joining me on my YouTube channel, youtube.com/Chris Pulver. You may be joining me on Twitter, which is twitter.com/RealChrisPulver, Facebook, facebook.com/The Real Chris Pulver, and maybe on LinkedIn, maybe on Twitch for any gamers out there. But anyway, good way to join me. I post this in Telegram. Hopefully, all of you are having an easy onboarding. So it's Monday. It was actually a very calm Monday, which was perfect. We had some nice trades this morning. I just finished up a trade on Amazon. I'm long the shares. I've been long the shares for a while. I have a covered call at 210, and I just put in a long protective put at 160 to be safe. So I'm just going to label my charts here. I have a 11-1 expiration, 160 long put. That was $1. That would have been filled at $1. Let's see here. Let me see where I got filled. Let's see. I opened at $1.70, $1.68. So $1.68 debit, and that's all the way back down near this low. And then I've got the 210 way up here. That's a 12. That expiration is out to the 20th of December. So 12/20 expiration, 210 covered call. So I just want to be adding in another protection level on Amazon in case we are looking, in case we're looking for some type of corrective move. This week is all about the Fed, and it's all about what price action does after the Fed. So don't think that this is a great thing that the Fed is cutting rates. I think that it should be. I think that here's the scenario. Okay, so we have the Fed rate cut is finally here, right? This has been highly anticipated for over 9 months. A lot of this big pivot from the Fed was last fall, last December. The bullishness we've seen has been the market kind of pricing in solid earnings. The Fed is going to be more dovish, or the Fed is paused in rates, and now they're going to start cutting in rates. All these things are finally here. So could it be just a simple buy the rumor, which has been this melt up for 9 months, and then sell the news, which is this Wednesday? Maybe. Or is it the appropriate cut where we really see that the Fed is restrictive? And let me know, can you type in a wire yes in the chat for me? Is my font large enough for you to see on your screen? Just let me know. If I need to go a little bit higher with the font on TradingView, I can. But if you can see my screen okay, just let me know. All right, Paul's in the house, Cabby's here, Giselle's here. Nice to see everybody. Good afternoon. Happy Monday. Welcome to the live session. All right, Nimmer, what's up, man? How are you? Okay, so Fed is restrictive when the official cash rate is greater than the PCE. Okay, so the running year-over-year PCE. So if we go to US PCE data, okay, let's see what it shows here for the last print. All right, so July 2024 was a 2.5, June 24, 2.5, May 2.6, 2.7. Let me go if there's a current release here. PCE, here we go. So we're looking at March, April, May, June, July. Now, can everybody see this right here? Price indexes, the PCE 2.7, 2.7, 2.6, 2.5, 2.5. That is PCE. That is not core PCE. That is the overall PCE. But still, if the Fed funds rate, which right now we're sitting at 5.5%, okay, so Fed at 5.25 to 5.50. I don't think that font needs to be so large. Try that again. Fed at 5.25 to 5.5%, right? That's our current rate. So if we have Fed at 5.25 to 5.50, and we see that the PCE and core PCE is 2.7, and now these latest prints have been 2.5 and 2.6. That means that the Fed rate is up here and the PCE rate is down here. And this has been, for a while, the Fed's preferred instrument and metric to see, are we officially, putting on restrictive monetary policy? And the answer right now is yes. And it has been that way for a while. As we raise rates aggressively, 2022, 2023 finally hit the pause cycle. The Fed's held rates pretty steady, and the market has not really been too shaky outside of that sell-off in July and August. Really, the rate situation, the Fed's been pretty lucky to have successfully talked and jawboned the markets through this kind of soft landing scenario. The U.S. economy looks to be fairly resilient. Obviously, there's certain sectors that are performing better than others. It's an interesting year to have gold leading the S&P right now, gold outpacing the NASDAQ, and also having sectors like utilities and financials and consumer staples being some of the top sectors in the markets right now. That's not normal. Okay, but point is we are still restrictive. And so what the Fed has is it has this cushion to reduce rates to the downside as long as PCE doesn't start coming higher, as long as inflation doesn't start coming higher. We've seen inflation trending lower year over year. We've seen PCE inflation or PCE trending lower year over year. And this is the right direction for PCE to go lower, inflation to go lower, and it's finally given the Fed the confidence that they can start cutting rates. Now, the weird thing for this last week, if we go to the watch tool, this is updated as of right now, so 3:07 p.m. on the 16th. The markets are looking at a 61% probability that Wednesday's rate decision will be a 50 basis points cut from the Fed. Okay. Now, last week, this was in the 80% that we'd have a 25 basis points cut. I still don't know if the Fed is going to cut 50 points. I'm actually a little bit more concerned that if they do cut 50 points, then we have a much more aggressive reaction. Now, I'm not saying that reaction is bearish or bullish. I just think there's going to be a lot more volatility if the Fed for months and months and months has talked about, policy, it's time for a policy change, it's time for adjustment in policy, but they have been pretty steadfast on this 25 basis points cut. All right. Now, I also think with whatever happens on Wednesday, and we'll figure it out, we'll navigate it together. And I'm going to be live for a 1:30 session for FOMC. I'll be live again for this time here. We'll trade pretty much the meat of that closing bell from 3 p.m. to 4 p.m. with this new segment that I'm doing called the Final Hour. And we will be right in the heat of Jerome Powell's press conference wrapping, see what the final hour gives us. If there's anything to trade, maybe I'll look. Otherwise, I just want to see, I think we should just hang out, have some popcorn, watch the price action and see where things settle. Because if we have a 50 basis points cut, I think the market's just going to react more aggressively. And I don't know if that's up or down. I really don't care. And so the trades that I took today were basically plain volatility. All right. So the rate cut's finally here. The Fed is restricted when it comes to the PCE, as long as the PCE remains lower than the official cash rate. Right now, there is just shy of, let's say that we have the 5.5% cash rate, 5.5 minus 2.5. We have about 3% buffer right now between what the Fed is holding as restricted monetary policy to, going even essentially with PCE. Okay, and that's core PCE around the 2.5. If I go back to this here, we're at 2.5, 2.6 between the core and the regular PCE. So roughly 2.5 to 3% of padding. And what that means is the Fed does have some wiggle room to start cutting rates. Now, I also wonder is as we go into this week and things get priced in, if we go to the probabilities here, okay, what this might end up shifting is if the Fed is aggressive let me change the color. If the Fed is aggressive and does come out swinging with the 50 basis points cut, I do wonder if this changes the probability for the cuts in December. So can you see here that here's where we're currently sitting? Okay. This is where we're currently sitting right here. and this is the 5.5. So the probability right now, you go to this blue highlighted section, this is the probability that we're going 50 basis points. And then for the month of November, okay, so we'd skip October, the month of November, this is another probability that we cut another 25 basis points. You go into December, look at this probability right now. Probability for December is we're going another 50 basis points. So we would have, and this is all potential, this is all, conjecture, but the market could be shifting this as soon as Wednesday, Thursday, Friday this week. But the summary is I'm going to take a screenshot of this. So right now at 3:11 p.m. Eastern time on September 16th, okay, there's a 61% probability the Fed cuts 50 basis points this week. And then there's a 50.2% probability the Fed cuts again by 25 basis points in November. And then there is a 43.5% probability the Fed cuts again by 50 basis points in December. Now, that is pretty darn aggressive if you ask me. If we come out swinging in 4 months, have 3 cuts, and we cut by 125 basis points before we even start a new year, that is aggressive. All right. So what I wonder with today or Wednesday's rate decision is Jerome Powell is going to have to speak to this, because usually we don't see this much moving and shaking, this many, changes in probabilities right before the Fed comes out on Wednesday. Usually it's very high in one leg. So, last week I was like, it looks pretty good. It's going to be a 25% base or a 25 basis points cut, because it was like 81. I saw as high as 87% last week. That's completely flipped. And now the market's like looking at the higher probability being the 50 basis points cut. Okay. So I'm going to take a screenshot of this right now and put a timestamp on this, because I think this is important to note that this is all going to change. And I want to see how much it changes, because it's not just about, how much the Fed is going to cut, but it's, how much and how quickly. And so that rate of change will be really important to see how price and volatility are impacted by that. Okay. So I'm going to put here September 16th, 3:13 p.m. Eastern time. And we'll put here, Fed tool snapshot. Okay. I want to take a screenshot of that, and then we can reference this through the week as things are likely going to change. I'll take a screenshot of the whole thing. So there we go. So I'll come back and reference this through the week. But as it stands right now, 50 basis points expected for Wednesday, another 25 in November, another 50 in December. All this is probably going to change, and I do expect Jerome Powell to have to talk about it. Okay. Nimmer says, I guess they will cut 50 basis points. That's my opinion. Well, I mean, your opinion's got a pretty good probability when that's what the watch tool says, and this thing hasn't been wrong since 2009. So at this point, it does look like the decision is going to be that, the Fed would be cutting by 25 or by 50 basis points. But I think what's wild is how much this has changed. And here's another image that I took this morning. Okay, right here. Equities typically rally following the first Fed cut if there's no recession. And this is the big key word: if there's no recession. Okay. Now, I don't think there is a recession. I don't think that there is a broad market recession. I think that we might have a you could use the word transitory. I think you could use the word segmented. Every sector has kind of felt the pain since 2020 in different ways and different times. So, like I said, we have gold actually outperforming the S&P this year. We have, Bitcoin is also outperforming the S&P this year. We have utilities as the top performing sector in the entire market this year. We have financials and consumer staples not that far behind. Okay, those are not sectors that usually outperform the broader market. So we are clearly seeing some inflows. We're starting to see some rotation. Could this be a more of a defensive play? Maybe. But that's why I said if no recession, because back in July, this is where things got really dicey when the employment news was looking so bad out of the US. Unemployment claims were higher, average earnings were down, the non-farm was missed. We had this terrible revision. We had the 818,000 jobs that were revised away from non-farm payroll from like March of 2023 and in March 2024. So from that side, that's what triggered the SOM rule. That was what accelerated the sell-off in July until early August with the Japanese yen unwinding at the same time. So the point is, historically speaking, if there's no recession, the market likes to go higher. If we are cutting in the wake of a recession, then the market usually is lower. And I know that that doesn't really help anybody do anything. But here's what I am doing, okay? I am cautiously bullish and I am forced to buy protection to the downside. That is all I'm doing. Okay? So I still want the overall markets to go higher, but I'm willing to spend, 25 or 0.25% of my account, maybe 0.5% of my account, and take little 30 to 60-day hedges just in case. Because if I win on a hedge, a 0.25% hedge could possibly, pay me 1, 2, maybe even 3, 4, 5% if I really get one right. I could offset a lot of pain with a nice, nicely placed hedge. And I typically go out like 30 to 60 days. But if those do not become any, if they're not profitable, then the market does its thing. The market goes higher. It does sacrifice a bit of my bottom line, but to me, I'd much rather have the protection than not. Because if we do have a downturn, I don't want to be stuck like, oh fudge, now I'm in these drawdowns. I want to be able to take, any downturn in the market. I want my P&L to essentially be at the same level. So if my watermark is right here and we have a downturn, I want my watermark to still be here because I've hedged properly, and I can still keep my profits that respond from those lows. I can then increase my overall profit and get to new balance highs where I'm still making money. So I think that's the hard part is I'm essentially taking neutral to bullish positions while protecting the downside. I'm trading a little bit more volatility outside of the next like 30 to 60 days. I think that for the month of September, we're likely going to still see a lot of chop. Once we get through this Fed decision, remember we've got an election to worry about here in November for the US. We still have another round of inflation. We still have another round of employment news. We'll still have some data to drip in. October is going to be mostly earnings season. So combination is this. Okay. Fed's not worried about inflation anymore. They're worried about the job market, which is not looking very good. I think they will continue to worsen. True. But the point is, if the Fed does cut by 50 basis points, it clearly shows that they have miscalculated, the labor market. But I do think that this cut, look, a 50 basis points cut is going to be way more favorable for the consumer. Right? This is good for any type of activity in housing where there's tons of household wealth and equity. Most of the housing balance sheets have been saved because of the appreciation in prices. The U.S. has one of the most unaffordable markets ever when it comes to what people make and what's required to own the median household. Or the home right now is like, I want to say our prices have gone up. The median home is probably closer to $400,000 right now, and wages have not increased that much. I think wages are up, I don't know, 20%, and houses are up like 50 to 100%. So it's unaffordable. On top of that, you've got supply issues. You've got existing homes that have been sitting on the market longer. You have interest rates at these crazy highs that they've come down a little bit. The 30-year mortgage is down to 6.2. Mortgage at 6.2. But you need to see another, probably another 100 basis points or more before you start to see a little bit more moving and shaking and refis. You start to see more come online. You start to see people making that decision like, okay, every 1% is going to save somebody roughly $500 a month. So there's a lot that could be said there if we see it, 50 to 100 basis points reduced out of 30-year rates, that there will be a lot more activity in the housing market as supply continues to catch up. But there also, the one thing I think is this this invisible hand in the background that not a lot of people pay attention to, is freaking home insurance. I think that over the next 3 to 5 years, we might have rates that are dropping and more supply comes online. But if we're getting gouged by insurance companies, that's going to be another problem where your homeowner's insurance, which should be pretty freaking basic, is going to become more and more expensive. So that's one thing I'm watching in the background. And I hope it doesn't become that where it just adds to the pain of owning a home, and you start at the mortgage, but you've got all your extra fees on top of that. But long story short, the Fed cut is finally here. As Nimmer said here, 50 basis points. The Fed's more worried about employment, which I agree. But cutting 50 basis points does not fix the job market. That's what's so silly about 25 or 50 basis points. It really doesn't matter what the job numbers are coming out good or bad, regardless of what the Fed's doing on Wednesday. There's no way that cutting by 50 basis points is going to save anything. So I just wonder how price is going to react to it. I think that's ultimately what I'm taking away from this is if price is going to be a fake out trade. I mean, we're sitting here near the all-time highs in the S&P. We're sitting here, at this kind of critical point on the Nasdaq. We're sitting here on the Dow at all-time highs. What a perfect spot on the Dow to fail, right? I mean, I see this. It's like, and I'm not trying to call the top here, right? I'm really not. But could I see this, this rip to the upside from low to high? Could I see this move of 4.47% in 1, 2, 3, 4 trading days? Could I see this fade over the next couple weeks? Totally. And maybe I'm dead wrong. But I have, a pending order down here to buy. I've got a pending order down here to buy. I'm looking to see, I might even consider a sell trade. If price came to like 430, I might look to fade that move in the near term, but I don't want to call the top. I think that's silly. Okay. Anthony says the Fed goes to 50, it threatens US dollar carry trade, may crash. Sure, maybe. I mean, that depends on the Bank of Japan too. I mean, you have to remember, we're all in the same, the global economy, Japan and the US are pretty much in the same boat together. Whether we like it or not, it's like Japan is they're the trickiest central bank to predict on what they want to do. They could sit here at 0.25% and they could go back to zero, right? They could go to 0.25 or go to 1%. If you look at the dollar yen, I think the dollar yen is pretty much on its own island along with everything else, right? The yen, look at the yen crosses. The dollar yen made a fresh low because you had dollar weakness. To me, this is a good opportunity for a short-term squeeze where oversold conditions, we took out a low, we've got some liquidity levels. I could see the dollar yen coming back into here and giving us this mostly big swing that we come back in and we deal with some indecision and we don't break the high and we don't breach whatever this low is that it's established here, whether it's just recently. If we come back to this low, I could see us pulling back into equilibrium, and then it's a lot of this on the dollar yen. And nobody knows what's next on the dollar yen outside of if things get worse, then sure, there's the dollar yen in the next, maybe 3 to 5 years. Maybe shorter if we see that the BOJ is raising rates and others are coming down to it. That does pretty much reduce or take away the entire carry trade. But to me, the entire global economy does not hinge on the dollar yen. Bank of Japan is a debt-ridden country that they've got their own problems. But you look at their index, I think the Nikkei, for where it is with a 27% sell-off, look, I would like to scoop up some Nikkei. If we have another sell-off, let's say we go down lower on the Nikkei, but we fail to break these lows, I'm looking to buy the Nikkei. I think the Nikkei longer term is still fine. Also, we're coming into a phase of the Nikkei where, remember what the U.S. markets did? The U.S. markets, as we raised rates, the U.S. markets actually went up, right? The Nikkei has been on a rip for the last decade plus, actually outpaced the S&P 500 and the Nasdaq this year. Was one of the best performing indexes in the world until we had this monster, little haircut at 27%. So from this 27% dip, I'm pretty interested in the medium to long term that if we come back down to this level, I'm looking to establish at least some long positions on the Nikkei. Even if we're not talking about the Nikkei going to all-time highs, I could see this low being pretty well supported by the Bank of Japan, and monetary policy will be a part of that. But I don't know. And again, I'm not all in on Japan. I'm not all in on anything. It's just a trade. But for me, if I was to call that support, I would say that I've got a good opportunity to buy low and see that this thing can at least go somewhat higher, if not find a way to get to all-time highs. Okay. So we'll see. We'll see. So look, there's a lot riding on it. At the end of the day, I'm not in control of what the Fed does, whether they do 25 or 50 basis points, and I agree or disagree. It doesn't matter. All I can do is trade price. All right. So what I am doing, I have a trade that I put on today for the SPY. I'm essentially going both directions out to October 4th. So that gets me through this week. That gets me through next week to wrap up the month on the 27th on Friday. That gets us through the quarterly expiration on the 30th, which is Monday. And that gets me into the first week of data, which will be non-farm payroll on Friday the 4th. So all I need to see is I need the S&P to move about $8.50 up or down to make money. Okay, that's all I need there. On the Qs, I need the Qs. I believe this one was an $11 debit. Let me check the Qs. 1150 debit. So I need for a currency or a currency, an index that moves $20 a week on average, $19 a week on average. Okay, I need $11.50 up down to make money. So do I think that we're going to have enough volatility to consider over the next couple weeks to trade this thing and make, a $50 to $20 move one way or the other? I think yes. I hope, and if we deliver in one bigger way than the other, that's great. But that's all I need. So SPY and QQQ trading some volatility there. The DIA I'm staying out of for right now. The Russell, I want to keep a close eye on this one because I will probably come back to these lows and try to establish a core position right there to then build some support to the upside. Okay. So I still like the Russell making higher highs and higher lows. I think also a cut in the Fed side of things does help small business. I think it does help the small caps. I think that this is a way for potentially the Russell to actually outperform versus the Qs and the SPY. We still have this bit of catch up trade if we come to all time highs, and this is, I don't know, some people hate this trade, but I think for this opportunity to have the SPY at all time highs, the Qs not at all time highs, but has obviously hit all time highs several times this year, the Dow at all-time highs, and the Russell still quite a bit off those levels. If we see a fair amount of aggressive rate cuts, this could actually help spur the recovery trade and the catch-up trade on the small caps. Now, there's a lot of small cap stocks that are underperforming, and they might continue to do so. But something like the IW, it's like the top 200. I think it's IWF. That's the 1,000 growth. That's not IWF. IWX. Yeah, the top 200 value. So this one is just off the all-time highs. So the top 200 value has been performing pretty well versus the overall 2,000 in the Russell. But I still think the Russell has room to catch up, and I'm looking at something very simple like the IWM to take that trade. And if we get to those all-time highs and we do it by this year, that's still an index that can perform at 12.47% to the upside, which I'd be pretty excited about because there's a lot of stocks inside of that Russell 2000 that can do way more than just 12.5%. Okay. All right, let's move on. So volatility index, the VIX. Can I put the SPY trade into the chat? I have it in. If you follow my my Discord, I posted that in the A1 Trading Discord. I put all the links to that trade this morning in the index trades. I did one on the SPY for a 10-4 expiration. I did one on the QQQ for a 10-4 expiration. Yep. So it's a buy call and a sell call. I'm sorry. Yeah. It's a buy call, sell call, and a buy put, sell put to create the legs that I want and get it priced out for those like 850 debit and 1150 debit. Okay, the volatility index at 1705. We have slightly higher volatility. We're not at these $11 and $12 lows any longer. I don't know if the market brings on a bunch of noise and volatility. I mean, it's pretty simple. If we come down to this level here again at like $13 or $12 and the market melts up to all-time highs, I will likely trade some type of vol event before the election or into the end of the year. And this might be another thing that reminded us into late 2017, early 2018, another kind of a little bit of a Volmageddon event, which we had back here in August. But if we come into this week and the volatility is slightly elevated and we just kind of range around here between like 15 and 25, the market's a little bit elevated, but pretty contained. And we don't have some outlier vol event. We don't have, crazy low volatility. The market just kind of stays where it is. And maybe it's not as exciting as everybody thinks it's going to be or wants it to be. And I think that's the reality that a lot of traders don't really think about is everybody wants all this crazy wild volatility. Everyone's so worried and scared that the market's going to break. But the reality is the market just finds a way to just do what it does best, which is just it does something. It does something every single day, up a little, down a little, up a lot, down a lot. The market exists. There's ways to trade it. There's ways to exploit it. There's ways to make money, right? And you can have all these different horizons, short term, medium term, long term, but the market is what it is. So volatility, I will get long volatility if we come back to here, okay? If we come back to here, I will get long volatility. If we come up to here, then I will probably end up getting short volatility and probably end up placing another trade on SVXY or SVIX. I'm currently I'm pretty engaged in SVXY. When we had that big event in August, that first week of August where the sell-off hit the bottoms on the 5th, I did some aggressive puts that gave me I want to say like $4 or $5 credit, and then I also bought the shares at 40, and I put on a $35 put. So if I was assigned anything on SVXY, let me go to the chart right here. If I'm assigned anything on SVXY, my break even is going to be somewhere between. I own shares at 40, put at 35, puts at 54 down to 50. I will probably say that my overall position is going to be around $45. Now, if the markets, i.e. S&P, mainly the S&P, if the S&P finds a way to eclipse the highs and start melting up higher, this SVXY is probably going up to fill this gap and maybe even come up and close out or hitting this high. This is my target on the SVXY. I'm just trying to get this thing, up in profit, 55 to 57.50, $60 would be great. All-time highs would be super exciting, but I don't know if I'm going to hang on to it that long. And then I'll just end up taking a big chunk of profit on SVXY. Okay. All right. Let's see. Yeah. Discord. Yeah, I've got my Discord. If you want to join my Discord channel, that's another spot for people to find all my content and stuff. It is, let me find my Discord here. Chris Pulver Trading, invite people, copy. All right, so here's my Chris Pulver Trading Discord. Okay, so I have a Discord there that's free for everybody. And I also have a Telegram that is free for everybody. And I'll post that as well. So here is Chris Pulver Trading Telegram. So you can join either one. Some of you might be coming in. You're already in my Telegram channel. That's great. Some of you coming into Discord. That's great. Just allowing me to have all my content out there in one place. So a lot of posts in Telegram, a lot of links in Telegram, a lot of posts in Discord, stuff like that. Okay, let's go to gold, silver. Yep, I see gold and Bitcoin, absolutely. So gold's up to 2581. Let me bring this other workspace up here for gold. This is Clean Living Charts. This one should be pretty good. So I got a lot of crap in these charts. This is why I moved away from it recently, but I will come back to it just to see if I can spot some overbought, oversold conditions. Yes. So this is gold. Nimmer, you know this one well, right? Our weekly chart on gold is showing overbought conditions. So look, based on this, just go back in time here. When did we see some overbought conditions in gold? We've had, very rarely we've had some crazy runs, but when we do, there tends to be a high coming, close. Now, I say that, but look at this showed overbought conditions with divergence and gold blasted higher before it came back. And we might be looking at the same thing. I'm not calling the top on gold at 2582. In fact, if gold just rips to the upside to $3,000, I'm probably going to try to trail, get myself stopped out with some profit before we have a bigger correction, and then this thing kind of bases again. So what I see here on the weekly time frame, it's rare to see overbought conditions, but we do see it, and we see that we had a capitulation move, then a correction. Same thing here, overbought conditions plus divergence. We had this big capitulation move, then we crashed again. So if we see it happening once again, overbought conditions, I've got a bunch of nonsense on this chart because of these fibs and noise, but this is the last time that we saw overbought plus divergence and the market did correct. Overbought plus divergence, does the market correct? And that is the question. I think right now the one thing that's really interesting on gold is that central banks are buying gold like crazy. And so I think that there's this permanent bid that is built into gold, right? Now that doesn't mean that I like buying it high because I really don't, but I would love to see some type of pullback. I'd like to see some type of pullback to give me a chance to buy again, or give me a chance to see a trend line behavior or some, previous resistance or breakout becoming support to just reestablish something on gold. If I don't get it and all we have is a breakout from last week and a little bit of a pause or pullback and we rip up again to all-time highs, then I'm glad that I started participating. I was participating in gold in here, heavy on the breakout, took some profit on some call options, started to buy GLD and started a dollar cost average into it. I've got call options. I've got credits or credit spreads. I've got gold futures with GC/GC, just trading some options. And I'm just trying to build my income. So overall, my gold positions right here. Let's take a look. Let's go all symbols. So gold, I'm up around that's what 60 $6,500 or so, $6,500 on GC. If I go to GLD, up around $9,500. So I've got a little bit of profit on GLD, but I actually like silver better. And I've been saying this for a while, but silver to me is a better technical trade because I'm not trading at all-time highs, and I think silver has room to run. So silver up 4,000, up 4,600, and then SLV a little bit heavier on the positioning and the ownership side. SLV is up around $36,000. So I'm hoping to run harder with SLV. And if we look at the chart between XAU, XAG, I'd like to see this continue to stay in a range that we've seen here since 2022 and 2023. This is some pretty solid resistance on gold versus silver. And so if silver gets the upper hand and starts to head lower, that means that silver is actually outperforming gold. If this chart goes down, that means silver's outperforming gold, which is why I like SLV. I like /SI as opposed to it. And I still have GLD and it's fine. And then my /GC is fine. But I like the upside potential on this more than I like gold. But I want to have both of them in my portfolio because I think they're good plays to have. So as a trader, I think silver offers more bang for your buck right now as a kind of inflation play, as a hedge with rates getting cut, with the dollar getting weaker, with one of the best performing assets in the world right now. Gold is a pretty good thing to have on your balance sheet. It's a pretty good thing to have in your portfolio. And like I said, central banks are bidding it in a big way. So I think that's also why we have this push and pause, and there's been really this anti-sell because I don't think gold is stopping necessarily. I think if we have a pullback, I'm interested to buy the dips on pullbacks. Pretty simple. So to what levels? Well, we had a decent resistance point right around 24.30. I'd say 24.50 or lower looks pretty good. I can label that here. So if I went to 24.50 or lower, so that's this previous resistance area. If that became support, or of course watching the trend line behavior somewhere out here. So between 24.50 and trend line support, or you can also just look at a simple, moving average. If we go to simple moving average, okay. If I put on one simple, oh my gosh, there's a ton of them. I don't want that one. Get out of here. Let's just go exponential. It's a little bit cleaner. Exponential, set it at a 200, and there you go. If gold pulls back to a 200 moving average, I'm going to buy the dip. It's that simple. So you can take the exponential, and you can also look at just the very industry standard, highly accepted. Let's go to the 50 moving average, right? You look at a 50. It's probably pretty well supported at the 50. Take a look at the 100. Okay, something like that. If all we have are these moving averages acting as dynamic support, you can see that gold has been in an uptrend, and we had a little bit of consolidation in here, right? A little bit of consolidation there, but the 50 and the 100 still acted as support, and 50 offering support. If we pull back to it again and we close back above it, there's an aggressive buy the dip opportunity, but we could certainly do it. So, if the 200 is too far away, the 50 and the 100 and the 200, I mean, if you like gold enough to have it on the balance sheet, 1, 2, 3, and I think this thing finds a way to go higher, I think you've got 3 good opportunities to enter just using some really simple moving averages, the 50, the 100, and the 200. Very simple. Okay. Good stuff. All right. What will the rate cuts do for gold? I mean, I think that gold in a way kind of front runs the rate cuts as well, right? I mean, the dollar is still very choppy. Gold has had a nice little breakout here the last 3 trading days or so after this indecision. I think this is gold kind of catching a bid prior to the rate cut decision, and maybe this is what's happening is it's priced in, So for right now, I could see gold not necessarily ripping higher, but actually offering more of a pullback when the dust settles. So in the short term, I do see the dollar. Just be aware of potential, bear traps on the dollar. Okay, let me get rid of these moving averages. So hide. I think this is a bear trap area on the dollar. If we come into these lows, which we've had this level since early 2023, fake out there in summer 2023, fake out during the holidays 2023, but we come back down to test it again. The dollar's been, hit pretty hard in a big way. I'm still kind of longer term bearish on the dollar, but But as we come out of summer trading and we've already put in a pretty dramatic trend, I don't know how much weaker the dollar actually gets. And so for me, I'm almost thinking that the dollar would fake out to the downside, rip back up to the upside, and then offer at least a equilibrium trade. Okay. And then we start to see a fade in the dollar, or we pull back again, and then we see a bigger fade in the dollar. And look, I don't think it'd be a surprise to see the dollar go sideways. And the reason I say that is because we have all central banks that are doing the same thing. Okay. Yes, the Bank of Japan has raised rates to 0.25 and they'll stay there. Other central banks are starting to cut rates. They're all doing the same thing. They're all cutting rates. Okay. So the dollar cuts rates and the market starts to price it in. This is essentially what happens. The market prices in the Fed way more aggressively. That makes sense? So I'm just saying, in the Forex world, I have seen this chart all year that this looks like a very easy trade to say, I'm short in the dollar. But if you looked at the Aussie dollar or the New Zealand dollar or the dollar CAD or the dollar Swiss or the dollar yen, or the only one that was a clean trade was the euro dollar. And that's because it's about 55% of this index is weighted in euro. So as this was a pretty straightforward downtrend, the euro dollar was a pretty straightforward uptrend, but every other currency came with these whipsaws before it finally caught some direction. You know, the Aussie dollar went up, down, and then back up again. That does not look the same as what you see here on the dollar index. So that being said, I am waiting to see. I'm not going to get faked out into some type of bear trap and then the dollar rips up here and comes back in the short term. Just saying. And why would that also be a trade that would make some sense? Because it's the complete opposite of what people are thinking, right? Everyone out there, for like the basic retail crowd, is thinking dollars cutting rates, it's going to get weaker because it's more of a dovish central bank. Well, the market's already moved and priced in a lot of these rate cuts. So if that's the case, it's usually buy the rumor, sell the news, and it does the opposite, which means I could see the dollar actually getting stronger in the interim, in the short term. Okay. All right. The Dow, somebody's asking for the Dow or the US 30. Yep. Take a look at that. Sure. So we're at all-time highs. I'm a little skeptical of this thing continuing to just rip to the upside, but just connecting the lows and connecting the highs, I would just be a little bit more mindful that if we come up into these highs, I'd be looking for some price action to suggest that we can put in a bit of a top and then start to fade a little bit of that move in the near term. Now, I draw these lines here. We have resistance, resistance. We have maybe just a little bit higher future resistance. We have support. We have support. I would want to see confirmation to start to short that in the near term, and I would do it probably through Dow futures. I would maybe consider some shorter term option trades and doing some bear call spreads. But just remember, if we have resistance here, support here, there's also this hidden middle point or this midpoint that could also serve as some support. So we might just come back to this level and then this level, this level, this level, right? And we still have a bull trend. We still have an uptrend, but we have less of the gangbuster move to the upside where it just doesn't capitulate. You know, so I'm a little bit, like I said, I'm skeptical that this thing goes crazy up without having a pullback. So that's all I'm saying is I would look more near term to see if the dollar or the Dow and the US 30 start to turn a little bit. We find this halfway point, or if it gets a little bit nastier, then we might pull back and find support. But we're still making higher lows for right now, and therefore we're still making higher highs. Okay. Key says, "What's your username in Discord?" It is my username is Real Chris Pulver. You come into my server, Chris Pulver Trading. My username is Real Chris Pulver. I say this to everybody coming into my Discord. You're never going to get a friend request from me. You're never going to get a direct message from me. You can message me, you can friend me. That's fine, but I will never initiate that or send that because I want to make sure that my Discord channel is for everybody and it's not full of direct messages. It's not full of sub threads and scams. It's just pretty much everybody gets to talk on the free group chat. Okay. All right. Any questions on the US 30 there? Good ask, good question. That's what I'm seeing right now. Nimmer, I want to go back to Bitcoin for you. So we did some gold. We did some gold conversation. Let's go to Bitcoin. Bitcoin is trading at 57.9. I still like Bitcoin a lot for potential accumulation. I'm looking to add, and it's mainly, so there's a couple ways that I'm trading Bitcoin. It's not just taking the coin itself. IBIT, I want to double check something here. I think I have a pending order on IBIT. So IBIT, I got filled 3150s. I don't have any pending orders. Let me put in a pending order here. So we had a move at 2850. I'm going to go ahead and put in another order. So what's another? let's see, 41 shares. I'm going to do another $1,000 by 28.50. So I'm going to put in another 35 shares at 28.50. Now, I would like to say that 28.50 is, if it's hit, I think that's a great spot to accumulate. And then back down here, let me see where this price was. We had a January 2024 move on Bitcoin. That was this move right here. So this was when we had Bitcoin spot price going higher as the ETFs were getting approved. We first had that pullback. I really like that spot. So I'm probably going to add in 2 more levels. I'm going to do let's go with IBIT. That low at 28.50, and then the low there at 20. I'll go 28.50 and 22.50. So these are going to be dollar cost average levels. Okay, so I get to go for 35 shares at the 28.50 mark, and I can go after 44 shares. So I can go 35 and 44 shares. So I'm going to do that right now. And then, what I'm looking for on overall Bitcoin is this. So I see these major highs, this resistance, this resistance, this resistance, this resistance. Right now, this structure, watching this high, watching this high, watching this high, what I'd like to see is, I mean, if price ends up breaking higher, that's fine. We don't necessarily break the highs at 67.5 or 70,000. I'd almost like to see this. I'd almost like to see price head down one more time, high, 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 and then I'm looking to see if and when we hold this level or we get up to the right-hand side breaking this trend line, then I'll start looking at position for more of a bullish push. So as far as my bigger trend, all this is to me is a monster accumulation opportunity, and I would be willing to buy this, at around 50K, around 40K, around 30K, and those would be my DCA levels as well. So dollar cost averaging. As far as trading, BlackRock and the ETF, it would be the same thing. I'd be buying it at the August 5th low. I'm going into this little pocket right in here at that January low when the ETFs were launched, and I will dollar cost average into that as well. So bigger picture, I want to have about 3 to 5% exposure for my portfolios in Bitcoin. Personally, I'm comfortable more with like the 10 to 15%. I still think it's a risk. Okay. BITO, yeah, Terrence, good question. IBIT and BITO. Well, BITO, you can trade options, which I like. But what I'm not loving about BITO is look at the difference in performance. Just look at the structure difference between BITO. This does not look like Bitcoin. Okay. Bitcoin was up here and sideways with a slightly lower low. Okay. This instrument is not doing the same type of thing. Right? I mean, heck, even MicroStrategy trades closer to Bitcoin than BITO. So MSTR's MicroStrategy, this looks a lot closer. And in fact, this is more sideways than even angled downwards. But if you have this slightly lower high, slightly lower low, after this rip to the upside, this looks a lot more like Bitcoin does than BITO. The nice thing about BITO is you can trade options, but the fact that it looks like it's losing that correlation, I'm not as interested in putting money behind BITO for right now. So I'm going more BlackRock. I think BlackRock with its hat in the ring for Bitcoin is a big thing. They were part of the big reason that also the ETFs were approved. And the same thing might happen on, there's some Ethereum ETFs as well. But I think BlackRock handling, multi-trillions in assets under management is a power that's going to be pretty impressive to at least keep in the space. So, BlackRock with real estate, BlackRock with crypto, BlackRock with assets under management in general. It is a a monster out there that I don't know. Is it too big to fail? Probably. Is it a private equity bubble waiting to happen? I don't know. But for me, I think the IBIT, because it looks like the spot price of Bitcoin, I'm going to trade this one instead. Okay, so that's why I'm not going heavy on BITO, because I do have BITO exposure, but because it broke down as far as the spot price correlation, I'm being more patient with it. And when it's appropriate, look, if Bitcoin starts to go higher, then BITO, just to establish some call options and speculate, I think that's an easier position. Otherwise, I'll just stick with the IBIT and I'll stick with MicroStrategy and a couple others that I like to play for Bitcoin. Getting on the balance sheet of some of these companies. Okay. All right. So we're good there on Bitcoin. Ethereum, same thing. We're coming into a bit of a wedge. We have the August 5th bottom that I'm watching. I'd like to see longer term. I'm hoping that this outer trend line here that's been pretty accurate for a while, if we come in and have a bit of a bear trap and then we rip back up here, obviously on the right side of the trend line, Ethereum looks way better. But I'd like to see if there's a bit of a bear trap and then see if we can start establishing position somewhat early, stop loss below, and then let this thing go. I mean, think about the asymmetry here. We get a bear trap, and all of a sudden you can put a stop loss below that low. We might have a 2 to 3x upside just to get back to these highs, and we get to all-time highs at 4,800. You just add another layer of a reward on top of that. So I'm looking at possibly like a 4-to-1 return risk reward if we can keep an eye on Ethereum. But again, it's just a trade. It may not work out, but I'm keeping an eye on this one. I'm trading both Ethereum and Bitcoin futures, and I'm trading a lot of credit spreads on those futures. And then Ethereum, I'm just holding EETH is the way that I'm trading options. That's how I'm expressing some credit spreads on Ethereum right now. Mostly bullish. Copper's come back in a nice way. I started to get some credit spreads in here on copper around that 390 handle, and so far that's looking pretty good. I didn't do a huge position on copper. But I do have some exposure. HG is right here. It's up about $1,000, and that has more time in it. So I'm going out to October, just a credit spread, and hopefully there's more to decay. But yeah, this is going to be a huge. It was just an income play. It's probably going to be like $300. So nothing crazy. Let me see here. Maybe I don't know. Copper. I'll probably stay out of it. If I'm interested in copper, bigger picture, I'm probably getting back down here towards 350 or lower. Not right now. Japanese yen we talked about. Okay, it's a crazy currency. We broke the highs recently. And look, the Japanese yen futures looks like the inverse of the dollar yen, does it not? So the dollar yen had that big drop all the way down to August 5th. We had that little pullback, and then we faded down to fresh lows. You have the rip on the Japanese yen futures, pullback, and then the push up to fresh highs. It's the exact same as the dollar yen, just the inverse. So if the dollar yen starts to go up, I expect the Japanese yen futures to go down. Okay. The reason I'm not trading this right now is I don't know what the dollar yen's going to do, and I really don't want to. I don't want to freaking put myself in harm's way for something stupid. If I did, it's going to be risk, like risk defined, and I would just set if they risk $250 to make $250, it'd be something like that, but nothing crazy. So the best trade that I had on the yen was this. I mean, I was long Japanese yen futures, and I was long FXY, and that trade was looking really good for that mid July into early August crash. But now it's more of a waiting game. Okay. All right, oil. Yep, I'll do oil for you, Jonathan. Sure. Oil trading at 70.50. I put in some credit spreads on oil. I have a couple things: 65 puts, 65.50 by 50, 65.50 by 64.50 credit spreads on CL for crude light futures. And I'm looking to see if oil will just range. That's really it. I mean, if oil just finds bid here at these lows, right? There's decent support going back into 2021, 2022. If oil just comes back into maybe a mid price at 80, I don't know if oil is going to have what it takes to get back to 90. The reason this has been falling is we've had heavy amounts of U.S. production, and we have a big slide in global demand. And oil has been moving in a bad way. But what was interesting this weekend is I saw that most hedge funds are net short oil. And that's only happened like a few times in history, and usually they've been dead wrong. So I am not short on oil. I am long oil directionally with defined risk. So if we go into an oil crash, my risk is defined and I can absorb any of that. But if we are correct with this thing going up, I think this is a good technical opportunity to be long oil over the next maybe 30 to 60 days and see if this just bounces back. I don't know what oil is going to do. I mean, we know that oil can get to zero. It did it during COVID. Could it happen again with an oil crisis? Sure, maybe. But given the Middle East tensions, giving OPEC is kind of a backstop and kind of this forever put in the oil market, I wouldn't be surprised if we stabilize here and we rip back into the 80s and we just stay right there, and then 80 becomes up more or a retracement. I don't know, but oil back up to 90 would probably put a lot of pressure on inflation. One of the reasons our inflation printed in the U.S. down at 2.5 is because pay at the pump is way lower in the U.S. So oil prices going way down has certainly helped bring inflation down in the US. Okay. See here, Jeffrey said BITO is actually futures of Bitcoin. I mean, it's based on futures contract, yes. So BITO, you can read it here in the description. Okay. So this is exposure to Bitcoin returns in an ETF wrapper. The fund does not invest directly into Bitcoin. It's cash settled front month Bitcoin futures, right? So we've seen a lot of order flows. Again, I mean, BITO is a legitimate instrument. It's a nice way to trade it. It's a leveraged way to trade it. But like I said, when it started to break away from the actual spot price correlation, when you can look, if I overlay a chart here, let's take this BITO and I'm going to overlay Bitcoin. Okay, I'm going to put in, let's go, well, let's just go, I'll try this. Okay, tell me which one looks like it held up better. Bitcoin is my line. So this is my Bitcoin line, and this is BITO. That's why I started to move away from it, because it is way underperforming compared to what we see in Bitcoin. But if we see, that Bitcoin catches bid, the catch-up trade is that this one likely plays catch-up faster. So just as it is underperforming, we could see it, outperforming and playing the catch-up game when it's appropriate. But I just think right now everything in Bitcoin is about slow, steady accumulation. The price action hasn't suggested really anything other than that. So that is why I'm just being patient. Fair. All right, good stuff. Let's see here. I got Mag 7s. We've got the bond market. We're up to 101.30 and TLT. I'm still long TLT. This one should be up a decent chunk of profit as well. TLT is here, up around $17,500. I'm trying to get this called away at 103. If I get it called away at 103, this is out to October 18th. If we see additional drifting where the market is pushing yields lower, bonds higher, I get another $1.70 in profit. That would be, I don't remember what my break even is, but I think I get another $1.70 at 400 shares, 680 times 8 plus 17,490. So I'm looking at about $23,000 in TLT profit if I get it called away above 103. My symmetry level on TLT for my bond play is 105, and it's just taking this swing right here. Low to high swing, symmetry gets me up to 105 and change. I've got a sell call sitting at 103. If I could roll it, I might, but I'm only going to do it for a credit and do it short term. Otherwise, I just let price go above it. Hopefully, it gets called away and I time it pretty well. Okay. All right. TMF for more punch. If you're talking about something that's leveraged, nope. No thanks. No thanks. No thanks. You got to be short term on TMF, man. I've had some pretty, and I don't know. Traders have given me way fewer examples of why they use double and triple leverage instruments to make money than them getting their butts kicked by them. Look, if price goes sideways or slow, those double and triple leverage instruments, they are repriced so aggressively, and you don't get the same type of value you would if you're just trading the instrument underlying at 1x. So if it's single leverage, it's a little bit more true to how it trades. If you're a short-term speculator, absolutely 2x, 3x, they work just fine. But I'm also not that I'm not that short-term. If I'm taking something on TMF here for triple leverage, I don't love holding this thing for months and months. So I don't. I just trade the single. I allocate, whatever I think is comfortable. But I get it. I'm just saying, be careful on those leverage ETFs. Their price action could be pretty tricky. Okay. All right. Bond wise, we did. I did look. So this is another thing I'm kind of exploring right now. I started looking at this into the weekend. This is Palladium futures. We've had a nice run here the last 3, 4, 5 days. I don't know if this is the official time to say, look, I'm going to get long Palladium futures, but it may not be a bad spot to look for. If I could get something maybe at 813, I'll see how this is priced. Also, platinum is another one. We had this monster sideways market on platinum, and I'm just looking to see if we come back and test some lows. So probably define risk on the futures market where I just look to do some credit spreads. Palladium, maybe. maybe something long, but it's hard to be long. It's also way less liquid than your other major commodities. But as far as a downtrend of 75% drawdowns, if we stabilize in here, that might be good enough to say there's some income opportunities on palladium. So palladium, I'm watching. Platinum, I'm watching. This is corn futures. I'm watching, right? We have multi-year lows that come back into, literally 2007, 2008. If we get somewhat of those levels tested again in corn, it's hard not to be bullish on corn. Even if it's with defined risk, I'd still be looking to get long. So I'm going to set a chart alarm in here. 350, that's close enough, I guess. And I'll put major support and see if I can trade it. So ZC for corn, ZS is for soybean, same type of thing, coming back into these 2008, 2009 lows. There's still a little bit more to go to the downside if we get there. But if we do, maybe some risk-defined trades going after some, support levels to trade and try to time it where I can make a few bucks on those futures trades. Okay, and then cocoa, that's another big crazy market we had this year. Cocoa futures, I just wanted to keep it as kind of a spot check, but I don't really have any interest in trading it unless I see cocoa back up here. If cocoa comes all the way back to these same like capitulation bubble highs, then I'll probably get short on cocoa and try to take this lower. Right. And then one of the more important figures that we should be tracking here, if you want to see if we're going to have a bear market recession, things get way worse and volatility goes way up, look at JNK. This is a Bloomberg high yield bond. All this shows us is the difference between like your AAA, triple B, triple C bonds. And if there is less liquidity in the markets, this goes down. Okay. So if you see this is going higher and steady and higher and steady and higher and steady, this whole risk of recession, this whole, something's going to break, doesn't look like it's happening yet. Right now, I understand like we had some wild and crazy times in here from 2022 into 3, but the bear market we saw during COVID's crash, the bear market we saw during 6 to 8 months of 2022, you can tell that this instrument was clearly going lower, right? And so until that starts to really turn south and fall off a cliff, right now we've got plenty of support, and I think buying the dip is still the way to play it, right? But having said that, I would like to see the market pull back a reasonable amount. I mean, if this is it, if we have this little, April pullback and we have this, July to August pullback, and then we have this little tiny September Labor Day sell-off, and we're just sitting here a week later and we're at all-time highs again. Okay, I mean, it is what it is, but all I need is, like I said, an 850 move one way or the other to make some money. I need an 1150 move one way or the other to make some money. I'm trying to think what else I'm trading here. That might be about it for right now. For the next couple weeks, based on volatility, the rest is just wait to see if the portfolio just gets a lift to the upside, or I'm just hedging to the downside. I did put some hedges in the futures market. I hedge here with MNQ. I did put on some hedges with MES. I'm probably going to do the same thing. In fact, I may actually look at that right now. I do have some longs on MES to the upside. So if we hit 58 and 59, I do have some long MES contracts. I may look at, I don't know, I could just see us like chopping around here for September and the market just can't make up its mind. I don't think we're going to get really a lot of direction. I'm more prepared for this. If I'm going to put a probability here, I think that this market struggles to go dramatically higher and probably just it works into some type of chop. I don't know. I think this market's going to get more exciting after the election. But here's what we have, and I'll let you go after this. We've been going for an hour plus, so I think it's a good time to wrap it up. We have Fed this week, okay? And then once it's done, it's price action, right? So price action will tell us everything. So I'm not trying to get overexposed and overpositioned right now. After the Fed this week, we still have the BOJ this week. It's actually Thursday. It's Wednesday to Thursday, I think. So like right after the Fed, we got BOJ coming out the next night. Are they going to do something silly and crazy? Maybe, maybe not. And the next week, we have the Swiss National Bank. We got the Bank of England this week, too. Swiss National Bank's another one out there that might be looking to cut rates. I hope that they do. I'm still long against the Swiss. But then the rest, it comes into, end of quarter. end of month, which is on a Monday, end of quarters, same time, but like your Friday expiration is the 27th. And then we have the 30th on a Monday. And then October kickoff is Q4, okay, which we starting to get to earnings season. And then it's all about the U.S. election. Because after this week, Fed is silent until November, right? We'll have FOMC meeting minutes. We'll have some Fed speakers sprinkled in, but the Fed doesn't do anything or take any action until November. So this is why what Powell says on Wednesday is really important, because if he gives any type of guidance, if he gives anything that's remotely explicit, you're going to see the market try to do something to price it in. And the market's already priced in rate cuts. And I don't know if the Fed is going to come out saying, hey, we're going to be more dovish and surprise the market. I doubt it, right? There's a lot of things the Fed's concerned with right now, namely employment. The U.S. employment numbers have to get better. The U.S. housing market has to get better. I think this is where the cuts come in. This is a cut to kind of help the consumer. People want to buy a new car, financing costs can go down. People want to refi a house or move, interest rates on mortgages go down. These are good. These are big, like long-term financing goals that if people are saving money on their mortgages, they've got more money to spend to be a consumer. And that's ultimately what drives 70% of our GDP anyway. So if you can save some money here, you can spend some money elsewhere. And that's the US in a nutshell. So the Fed is silent until November, which means it's going to be mostly about earnings. And can the market keep cranking good earnings? Right? So will the overall earnings consensus be positive? And it's not just EPS and revenue, but also forward guidance, right? If we have earnings that are positive plus optimism, then the bull market continues. Okay. But I don't think that the market is necessarily going to front run in front of the election, because there is a lot at stake for what happens November 5th with the vote. You know, is it Democrats? Is it Republican? Is it a full sweep? Is a Republican taking over everything? Are the Democrats taking over everything? Is it gridlock in the Senate and House? If that's the case, nothing's going to change if we have gridlock. The market loves gridlock. But I think the concern is that there'd be such a shift in policy if it's a Republican sweep or Democrat sweep. That's what the market is, I would say, likely going to have to price in and around the election, and there's just no certainty of that right now. So, I mean, I think the polls are still relatively tight. Maybe some 45s and 55s, but it's mostly what I see as 49s and 51s. That's hard to call an election from there. Okay. All right, so that's kind of my summary for today. We'll highlight this more and more for the week, but this is the big takeaways for today and what I'm watching. I think, tomorrow would be nice to see another quiet day in the market. All eyes on the Fed coming into Wednesday afternoon. I will continue to do this session here, 3 p.m. to 4 p.m. for the final hour. Hopefully, it's something you're interested in tuning in. Every session that I do will be recorded. It's posted on my live set or my archive on YouTube. If you miss it, you can go to any of my channels there. So YouTube and Twitter, Facebook, whatever. You can find those recordings right there after I do it live. Cool. All right. Thanks. Happy Monday, everybody. I'll be back tomorrow. If anybody's in my daily profit play for tomorrow morning, we'll start up again at 9 a.m. And if you want to come back to the final hour, I'll be live again tomorrow at 3 p.m. And then Wednesday, I'll throw in another session because I'm going to be joining A1 Trading right around 1:30 p.m. Eastern time for the FOMC. So busy day on Wednesday, but as it should be, as the market is obviously hinged on a lot of things with the Fed. But as it stands right now, looks like the Fed's going to cut 50 basis points for now. We'll see if this changes right into the decision on Wednesday afternoon at 2 p.m. But I don't think it really matters. I think we just sit back, we let price do what it does. We watch price action, we watch the order flows, we see where things settle, and we make our decisions. Post. I think it's easier to trade post Fed. Unless volatility is decent enough where we could actually take a trade. Like a daily strangle might not be too bad if we're trading at 2 p.m. and I buy a call and I buy a put and the Fed delivers enough volatility to get me paid on this. Maybe that's one way to trade it, but it is notoriously a noisy announcement, and you just end up paying for everything to go with no profit. This might be, it'll ask you to pay a $4 debit and you get a $2 to $3 move and you just lose all your money. So I'm not forcing any trades around short term. I'm going out a little bit longer to buy myself some time. Okay. All right. Thanks for that. RSS on my Discord, another scammer. Perfect. I'll get rid of them. Thank you for pointing that out. Good stuff. Can you talk a bit about your newly launched Discord service? Ken, I've been in Discord for like a year plus. Really quickly on that, all I'm doing is I'm using my Discord for just so my Discord channel is I have all of my content in one place. That's why I have a Discord. So if I'm live, it pops up here on YouTube. If I'm taking any trades or opening up conversation channels for everybody, that's what it's for. I do have education available. So right now I'm doing a daily session every single day, trading live with everybody. It's called the $100 Challenge. The strategy is called the Daily Profit Play, and I'm doing that live every day around 9 a.m. And you're welcome to join. It's through Prosperity Pub, and you can trade with me as early as tomorrow. So that's one thing. And then also with A1 Trading, I've been working with those guys at the team for a long time, Nick and Frank, and all the guests that they have on their network. I mean, they asked me to come in and help do a signal service. And so I'm offering through the A1 Trading community, I'm doing a trade signal. So I have indexes, commodities, Forex, stocks, options, futures, anything that I trade, I will post it here. And so it's a signal service there. That you can buy just for me. You can buy for the whole team. My Discord is for my own content to be parked in one place. My $100 challenge is going extremely well. Traders have been with me since last week. Right now, we've got about 350 members in it, and we're having some fun. I think that the light bulbs are going off. We're seeing the power of these strategies each and every day. I'm actually working towards automation on the strategy right now, which I'll talk about more this week. I've got a couple of irons in the fire with some developers right now, and then other things out here for my education. I've got software pieces that I can get you some deals on. I've got a great relationship, fortunately, with my broker with Tasty Trade. So a lot of people I've been experiencing, like, I pay so little in commission when I trade that I would love everybody to experience the same thing. I only pay 60 cents a contract for open or for options trades, and I only pay for the entry, not the exit. So Tasty Trade, it's $0 for ETFs, $0 for stocks. I pay 60 cents for an option contract for entry only, and then futures varies between $1.25 to $1.25. Cryptocurrency is also free. It's crazy cheap, and you can trade whatever you want. You want to trade options, you want to trade futures options, you want to trade indexes, ETFs, you name it. Tasty Trade is a freaking great broker. I've been very happy with them for the last several years. TradingView, I've got an affiliate link there. A1 Trading, Edge Finder discount from my end, plus the trade signals. All this stuff is all right there. So I just have it all in my Discord, which is Chris Pulver Trading. That's it. Cool. All right. Jim, to answer your question, no, I'm not. So this is my own thing, and I'm just working with some good people in the industry now. Okay, happy Monday. This session for the final hour will be back tomorrow at 3 p.m. Eastern Time. All of you are welcome to join. Daily Profit Play, $100 Challenge peeps. I'll see you in the morning at 9 a.m. If you want to join me on my YouTube channel with A1 Trading, I'll be live around 10:15 a.m. And that's pretty much how the schedule is going to be for the foreseeable future. And I'll probably sprinkle in some more services here and there, but hopefully we'd spend a lot of time together, and I'm looking forward to all that. Terrence says, I tried to access the masterclass. Terrence, that should be posted today. I think they recoded it, took away the password. That should be posted inside your classroom for the Daily Profit Play. The actual recording with no password link. If that doesn't work, let me know. Let me know tomorrow. But it should be posted today. They're going to resplice it and then post the whole recording. Okay, cool. All right, everybody.